Listen, a lot of mortgage companies right now, you've just switched over to a new LOS, or you're thinking about doing it right now. I'm telling you, you have to have Broker Plus added to the equation. They're working with Lender Price right now, which is fantastic for finding the best pricing out there. Now, with Broker Plus, it is the only POS, PPE, CRM, e-signature, mobile responsive LOS in the country. Again, why would you work with something if you know there's a better option out there? And if you think I'm wrong, all you have to do is click the banner down below and go test drive this thing and check it out, because I'm telling you, while things are slow, this is a time to get your technology in order. And Broker Plus is here to help you out. On with the show. So yesterday we told you about the mounting issues with Charles Schwab, who holds an astounding, I mean, just crazy, Joanna, $7 trillion freaking dollars in funds. It's a fifth of the world's money. Now, you want to talk about one company that can bring down the global economy? It's Schwab. Side note, it's not going to happen. But their stock dropped by 12%. And what that really illustrates is the jittery nature of international investors, both home and abroad. That point alone we should take note of, because sure, Schwab isn't going anywhere, but their stock drop, well, that's kind of a canary in the coal mine for other smaller banks and investment firms who may not fare as well with the jittery nature of all of our investors.
Now, we also explained via Eric Bowlby of American Pacific Mortgage why the failure of the SVBs of the world is absolutely not a black swan event.
Nope.
That being an outcome that nobody could have predicted. The run on banks was not only predictable, but courtesy of the Fed's hawkish policies. It was nothing short of inevitable.
I am inevitable.
But right now, today, part 2, which is what it is, check out yesterday's show, we want to move over to the European markets because, yes, economies are all now globalist in nature. What happens in Asia and what happens in European markets, it affects our markets and vice versa. So, on March 23rd, as it pertains to Deutsche Bank, their stock was trading at $9.94. By the 24th, the next day, it dropped 12%, just like Schwab did, and it was trading at $8.92. Now, why in the heck did this happen?
A single $5 million trade in credit default swaps for Deutsche Bank likely sparked last week's stock market decline, according to Bloomberg. And understand that credit default swaps are simply a form of insurance against a potential default of the company.
So what the real takeaway is here, it's not Deutsche finding themselves in harm's way. No, rather how they got there. It's crazy. A meager $5 million credit default swap as an insurance instrument was enough to plow down 12% of one of Europe's largest banks' stocks value. That's crazy.
I mean, listen, investors are jumpy right now, and it stands to reason that if we find ourselves with a real issue, not SVB big, but something bigger than a pedestrian move like Deutsche did with this swap, one might be led to believe that more bank failures is inevitable. We did a show a few weeks ago, and at that point, we had only had 3 bank failures this year and none in the previous 2 years.
So to put this whole thing right now, what's going on in perspective, between 2009 and 2010, the last big meltdown, yay, there were 297 bank failures. And that took a decade for us to recover from.
And according to a recent study, depending on certain market conditions, nearly 200 U.S. banks could be vulnerable to the same fate as Silicon Valley Bank. A recent Social Science Research Network study suggests that 186 American banks could fail if half of their depositors suddenly withdrew their funds.
And I'll tell you right now, Joanna, that's the black swan event right there, because they're saying 200, but they've already proven they don't know what's going on. That 200 likely could be 300, 400. They simply don't know.
Well, and if it happens, the other half of those people are going to pull their money too. So that's all the banks.
Yeah, and this is a case of pin the tail on the donkey. You just don't know where it's gonna land. And as we just outlined here, guys, with Deutsche and yesterday with the Titan Charles Schwab at $7 trillion, investors are as jittery as a newborn chicken. I got chickens now. And it wouldn't take much to push them off the ledge. And worth pointing out that our current state of psychosis is nearly 100% of the Fed's problem. Yes, I'm putting it on those fellas and gals.
Not just the current policy of stifling Fed rate rises and balance sheet reductions, but also what got us here in the first place, that being quantitative easing, which is really just a nice way of saying counterfeiting trillions of dollars and irresponsibly injecting them into our economy. Frankly, at this point, I think we'd be better off if the Fed took a 2-year vacation.
I know.
Head to Barbados, you guys.
Totally. Barbados would be awesome. Have a few drinks that require those little mini umbrellas like they had in The Jerk. Work on your tan. Over there at the Fed, you've already done enough damage to ensure that my kids at best will not have it better than their parents. And that's saying something. And it's disheartening. Sorry again for the Debbie Downer of a show here, guys. But really, I think this is important to understand because it's happening right before our eyes. And I'll tell you right now, 20 years from now, this will be in your kids' high school economics classes. They'll be talking about the decisions that are being made today as they will back in 2008. So since it's current, it's happening right now, we should all stay abreast of things that are going to have a long-term effect on generations to come. With that said, I promise you it'll be happier tomorrow.